Hello, everybody. Welcome to the online course for economics for Unit 9. Today we're going to be covering the topics which are in Unit 9, which are legal business creation, successful business creation, entrepreneurs, determining profit, and business cycle. All of which will give you a better idea of what small businesses do, how they're created, what a successful a business looks like, what they analyze, what entrepreneurs have to do to start one, things to consider, how they determine what their profits would be, and what exactly is a business cycle. So let's get started. First off, producers and distributors are often called businesses or companies or firms, but they're made up of companies that produce things or distribute things. Producers also are known as companies in which they provide a service. So it doesn't have to be a tangible item. It can be a service as well. But businesses come in many shapes and forms. Sometimes they're called those three different things, but they all really mean the same thing. When you hear somebody say, "Oh, it's a firm," it's the same thing as a business or a company. They're just using different words for the same thing. However, the most common type of business is what is referred to as a sole proprietorship. A sole proprietorship in which a single owner, one person, owns a business. Sole meaning one, proprietorship means ownership. One person owns the business. There's different kinds, but that is the most common type of business. You'll need to know that for your test, so keep that in mind. So business partnership is where there's two or more people sharing the profit and the loss of a business. It can be 50-50, but oftentimes it's not. Sometimes there's a person who, has, like 70% ownership, and they needed somebody to help them boost them up to, to get to that 100%, dollar amount that they needed to start the business. So it can be half and half, but oftentimes it's split up differently than that. And, but it's when two or more, so it doesn't have to be two. Oftentimes there's a group of people who decide to pool their money together to invest in a business, and they share in those profits and those losses. So on a business agreement, they decide what profit percentage each of those individuals would receive. And so when you are in one of those partnerships, you don't get the whole profit amount. At the end of the year, when you take your revenue and you take out your costs and you're left with your profit, you're sharing that profit because you shared the risk with other people. Other people took a risk to, join in on your business. Therefore, you pay them the profit for doing so. Sometimes it's a percentage, sometimes it's a dollar amount chunk, but it's whatever's in the contract. But that's what a business partnership looks like, and why it's done that way is so that you don't have all of the weight of the financial responsibility on your shoulders. You can share it with some other people. So that's a business partnership. A corporation is when you have several different things put together, but at least a corporation is considered a public company. It's not just a private institution. It has a charter, and a charter is basically a document that says it's a corporation, and it lists who the board of directors are and who the officers are on that board of directors. So officers would be CEO, Chief Executive Officer, CFO, Chief Financial Officer, lots of different there can be up to like a dozen, different kinds of officers, but they're always the EO, Executive Officer. And the board of directors are a group of people that get voted to be on the board to direct the financial dealings of a company, which mostly are bigger decisions, like a annual type decisions, not a day-to-day, not a month-to-month, but decisions that impact the business future and what they want to do down the road, not necessarily what to do with this month's problem sort of thing. So a corporation has at least those three things, and they're not a sole proprietorship. Board of directors, lots of it could be like a dozen different people that are voting to decide what to do with the company each year. Officers, there's there can be quite a few number of officers, and so it's not just one person running the show. It's quite a number of people who are making decisions on the behalf of an entire corporation. Big difference there. So when we talked a little bit about corporations and what that looks like. So we're going to talk about the difference then between a private corporation, which would be like a sole proprietorship, and a public corporation, which would be what the corporation I kind of talked about, the charter, board of directors, officers. So with a private corporation, it consists of a few people. Most of the time they're family members, and they rarely sell stock. Private corporations don't have a stock ticker. Their stock is not sold on the market, on a public stock market, and they rarely sell their stock, and most times they don't technically have what they refer to as a stock, and which means that they own a percentage of the company. And whoever owns a certain percentage of the company technically has like a stock in the company, but it's not a publicly traded one. It's a private corporation. So the difference between that and a public corporation would mean that public corporation does have a stock ticker. It is sold publicly on the stock market, and it's sold frequently. So day in and day out, there could be hundreds or thousands of buying and selling of the individual stocks that make up that public corporation stock. And there's many shareholders who own that stock, and in which they buy and sell frequently. It's made up of quite a few individuals who own those shareholders, not just a couple. And most of the time it's not family, because there's so many shareholders are all over the world. So big difference between those two. The next couple things I want to talk about is the different types of businesses that you can have. So the whole point of all of these different types of businesses to keep in mind is that all of these, the purpose of deciding what kind of corporation you want to have is to limit your liability. Okay, what that means is, say you own a house and a car and a boat and an RV, and all of that are your personal assets. That's what you personally own as an individual. Well, say you have that in one box. However, you are also a business owner, and you own your the brick and mortar four walls, of your company itself, and you own the equipment, and you own your registered trademark of whatever you're selling. There's lots of different pieces and parts that go into what you own as a company to make up your business. So let's just say for some reason you were sued. People get sued all the time for things that make sense and things that don't make sense. But let's just say somebody decided that they were going to sue you because they slipped and fell on the ice in front of your business. So what happens is they are going to come after your assets and sue you for the damages to themselves. And loss of money. So say that individual decided that they want to sue you for $100,000 because that's how much it cost them to go to the hospital, and for all their hospital bills, for having to have somebody drive them around because they are unable to drive, for the cost of them not being able to work for that certain time frame, cost of physical therapy, you name it. That's what it costs to get them back on their feet. So their lawyer is helping them sue you for that amount of money. So let's just say you don't have $100,000, and your corporate, your business is just a small shop and you don't have the profits from last year to be able to do that. You'd have to sell your whole business and or your equipment or something to be able to afford to give up $100,000 just like that. So what do? And if you were not protected by having a specific business type created, then they could go after your personal assets. Not only would they go after your business assets, they would go after your personal assets as well, which includes your house, your boat, your RV. So what that means is that they would take money from your business as well as take money from your personal assets. However, if you decided to create a specific kind of corporation in which you can limit your liability, you separate your personal assets from your professional ones, and you would limit the total amount that somebody could sue you for would be just however much is in your business, instead of what's in your business, the assets in your business, as well as the assets in your personal life. So, if somebody were to sue you, just like we had talked about, and they slip and fall, suing you for $100,000, they cannot go over the maximum amount that is in your personal assets. So if you only have $100,000 worth of assets, or $50,000 worth of assets, they can only sue you for $50,000. You'd go into bankruptcy for whatever that amount is. However, they cannot sue you for the extra $50,000 that you don't even have in your business. It stops right then and there. So that's the biggest difference, or that's the reason why you want to have, if you ever create a business, you want to ensure that you specify which type of business you are owning. So here's a couple different types. A limited liability corporation, in which it limits. That's exactly how you limit your professional liabilities from your personal ones. A professional corporation, in which you have a specific title to your name, like a physician or an attorney, or it could be an accountant. And you're just separating professional liabilities from personal finances. Again, and then I think I put that twice, limited liability corporation twice. Let's see if there is another one that I missed when I put that down there. Double check. Nope, those are the two best examples, LLC and professional corporation. So, then going on, there's a couple other different corporations, one of which is a nonprofit corporation, and that is one in which they provide a service for the public good. They don't put the profit, they don't make a profit for themselves. They're doing it for the public's good. They have what is considered a 501c3, which is a federally recognized charitable organization. That is basically, it's a tax number that specifies that they are a charitable organization, in which they get certain have tax-free exemptions, so that when they purchase things from stores, they don't have to pay taxes for it to be able to use it in their corporation. There's special other things. A couple of examples of nonprofit organizations are hospitals, charities, and anything that promotes the arts. So they're not in it for themselves, but to give back to others. So they have certain special tax exemptions that the government, allows them to avoid paying because of that. So going back to the for-profit, business world, this is what makes up a small business. It would have to be under 500 employees, being a privately owned and operated company that is not dominant in its field, as in they don't own 100% of the market share. Market share being like, let's just say, like Red Gold tomato ketchup, and let's just say that was a small business in Indiana, and they don't own 100% of all the ketchup in the United States. They only own a little portion of it. Let's just say they own 5% of the ketchup business in the U.S. That means that they're not dominant in their field, and they're still considered a small business. If they were dominant in their field, they owned 100% of it or close to it or something, they would be considered not considered a small business. So, some small businesses names they're also known as sole proprietorships. They can be partnerships or corporation. However, they're still under that 500 employee mark. So small businesses are also called micro businesses, and that's because they can be as small as 10 people or something. It can be micro, as opposed to big like corporations, which are multi-million-dollar ones. So these small businesses, it can also be called mom and pop operations, where it's a family-owned business. They don't have any more than 10 employees, but it's considered to be a mid-sized business if you have between 100 and 500 employees. So a couple of stats on small businesses. They 99.7% of the U.S. companies hire less than 500 people. So technically, the U.S. is made up of almost 100% small businesses. Half of all the small businesses survive after 5 years. So it's something to consider. If you're starting up a small business, do everything you can to make sure you're making those right moves. You're being smart with your money, and making business savvy decisions, because after 5 years, only half of those small businesses can make it. There's quite a few things that have to happen to ensure that your business survives past that 5 year mark, and a lot of businesses don't quite get it right. So it's risky. That just shows how risky it is to start a business on your own, especially a sole proprietorship, which is in which you're doing it by yourself. So when the more eyes and the more ears, the better when it comes to making business decisions, especially inexperienced ones. So keep that in mind if you guys are ever in the if you have a mind to start your own, that it's not easily done. So somebody who starts their own business is called an entrepreneur. Something to remember. Anybody who creates their own business is referred to as an entrepreneur. So the next best thing to being an entrepreneur, some would say, is being a franchise owner. But franchising is when a local business or person decides to purchase the right to use a name or a business of a large company. So say I really love Chick-fil-A. Everybody loves Chick-fil-A, right? So I decide that I want to run and own my own Chick-fil-A. However, I don't own Chick-fil-A. I'm not a Chick-fil-A owner. However, I can purchase the right to own Chick-fil-A. So they would interview me, and they would say, what's your business plan? How much money do you have? Can you, this is the dollar amount we're looking for. This is experience kind of person we're looking for. And they basically decide if you can be an individual that is, that they would want to use to own their business. So you're representing Chick-fil-A. So they want to make sure that you are Chick-fil-A, you're on par with what Chick-fil-A standards are before they decide to let you to own their part of their company. But let's just say you pass that test and you put forth the money to be able to use the right to their name and business and their model. You have to follow their business model. You have to follow when they put out a new product, you have to serve that new product. When they change their pricing, you have to change your pricing. And so it does come with some risk, because you are being told what to do by the main company. However, you are not having to deal with the risks. They tell you what your business plan is, and they tell you what to sell, and they tell you what the price is, and they have all that figured out. They know what makes a profit, and they know what can bring you down. However, and so you're not taking on the kind of risk that they are when they make decisions, and so it's a fairly safe business venture if you can do all of your management stuff correctly. So it's a lower risk way of entering in a market. Most of the time franchising is food related, but there you can, you can branch outside of that. However, I found Burger King, McDonald's, and Chick-fil-A, they're easily franchised. I've heard of that a lot. Like Ben's Pretzels, they finally did that, and there were a North Indiana Amish company in which they sold the right for other businesses to purchase the right to sell their product. And it's risky for even a company to decide to do that, let somebody do that, because they're giving away their business secrets, their recipes, their business plan to somebody who, and they're hoping that somebody who they're selling it to will prove to be trustworthy and reliable, and that they'll do what is asked of them to be able to keep it within their norm. Because somebody could easily change, the recipe or change something about those Ben's Pretzels, and it's more like an Auntie Anne's, and so people aren't, think that they aren't getting Ben's pretzel quality, they're getting more Auntie Anne's quality, and so they stop. It hurts the big Ben's Pretzels name in the end. So there's some tricky parts to franchising. Those are a couple, but there's some pros and cons to both of those. But that's what franchising looks like, and why it's done, and why it's it can be good and bad, but just different than a sole proprietorship, completely different. Okay, so let's just say you want to start a business. The key to starting a business, some of the keys to starting a business, I guess, are ensuring that your ducks are in a row. You've got, what you're starting with, and how to manage it. So, a couple of things that we're going to go through and talk about throughout the rest of this presentation are below there. However, first and foremost, you would want to appraise your talents and interests. So, if you want to start a jewelry business, you better be really good at making talented, interesting, awesome jewelry that people are interested in buying. Or if you are going to open a bakery, make sure that you're like a really good baker, and you've gotten good reviews and talents on reviews on your talents, and people are interested in what you have to sell. But just keep in mind that you want to sell something that you are interested in and that you're talented in. Otherwise, it won't do so well. Something to consider when you are starting is what your fixed and variable costs are. We'll talk a little bit more about that later on. But creating a budget, which is figuring out what you think your revenue will be, your cost will be, so that you can get an idea of what your profit will be if you stick to these certain things. And if you can get yourself to sell what you think you can, and determining what that is. Conducting marginal analysis on what your business looks like, and examining what your dead weight loss is. So, a couple of things that will help you determine whether or not your business will be a success or failure are these 5 things. One of them is overexpansion. The other is location. The third is money. The fourth is planning. And the fifth is management. So starting with management, what that means is how well you manage your employees, how well you manage product availability, managing distribution, managing prices, managing costs, managing employees, like all different sorts of things. So planning, the next one, is a little different. Planning would be, what does the spring season look like versus summer or winter? Planning how many employees you need during those seasonal times, or planning how much product you're going to need for next week versus next month. Planning on if you think your costs are going to spike at all. Planning your budget, planning whether insurance or rent might fluctuate for you. Planning, if you should add a second shift to your business versus a third shift. Planning how many people are going to be part-time versus full-time. All of that is making adjustments based on what's working and what's not working, or what is costing too much, or is bringing in too little. So the next one is money, and it's what you do with your money. Money decisions could look like whether or not you choose higher quality material, so spending more money on your inputs. Money could be how much you're going to put into savings versus put back into your business, so which would be invest back into your business. Putting money into savings would give you a little bit of sense of security. If something were to happen, you'd have a little extra there. Or how much of those profits to take out and give yourself a bonus or a raise with. Since you are the owner, you could do that. Money would be another way you could use that as who to give a raise to, when to buy new equipment with your money that you've got. Lots of different things that business decisions that you can make that determine success and failure. So anyway, the next one is location, and that's a big one. It determines how visible your company is. If it's off of 465, if it's next to a main road, or if it's way out in the middle of nowhere. Real small business in the countryside, that makes a big difference in what kind of people will come to your company on site, and if that matters. So if you're a farmer, I'm not sure that location is a huge deal. But it is a huge importance if you are a company in which people need to come to you, like a service industry company, or if it's a tangible product, or even basically any service industry where you have to be there in person. So location is big when it comes to availability of your product. Nobody wants to drive way in the middle of nowhere for something that they could get right around the corner. So that's pretty important to think about for a business. That can be a success or a fail, depending on where you put your company. Another item is overexpansion, and that means if you are overextending your money, or you aren't planning properly, you aren't managing your resources, or with your locations, overexpanding and adding too many locations, and they are robbing each other of potential profits, and saturating the market area with too many of the same companies. So a good example of that is Starbucks. Recently, they added so many Starbucks that they were competing with each other for the same people and the same profit. So they had to scale back the number of companies that they had in the U.S. Because they decided to overexpand and didn't realize it until it was too late. So that is 5 factors to determine success or business failure. So next thing we're going to talk about is how do you get a profit and the difference between accounting profit, economic profit, and a business profit. So start off with, we worked on this quite a bit when we did our birdhouse project, birdhouse versus bird feeder in-class activity. So you guys were able to determine which one was going to be more profitable based on how much the materials cost you and how much revenue, how much profit, I guess, real revenue that you were going to get from selling each item, and you had to determine which one was best. So profit is when you take total revenue, total products sold, and you take away the cost that it took to make that product. You're left with profit. Total revenue minus total cost equals profit. So to get the revenue amount, you are taking what you've decided your selling price will be, and you multiply it by how many you sold. So the price times quantity equals revenue. And that revenue is what you use to get to the profit. So that's what a business profit looks like individually. So the reason why you look at this next one, which is accounting profit, is you're taking into consideration costs that you would that have to show up on a balance sheet. In the accounting world, there's debits and credits, and the accountants in your company, which could just be you, determine what those profits look like based on what your costs are. Any costs to you are going to be listed in your balance sheet. So some might not show up in just a business profit versus an accounting profit, because accounting profit considers things like wear and tear on a machinery, and how that depletes the how valuable that machine is, and you can write off some of those costs on your balance sheet, on which that isn't necessarily shown in your total cost, business kind of profit normally. So accounting profit is when you take revenue and you take out the costs from that revenue. However, the costs are something that you aren't normally seen, which include rent, utilities, material, labor, but some of the little less tangible items are, like wear and tear on things. That's the only thing I can think of on the top of my head. A little bit about business profit and accounting profit. Next is economic profit, which is taking revenue and subtracting both opportunity costs and ledger costs from it, and what you're left with is profit. So opportunity costs, or a quick reminder on what that is, that's when you take, you're comparing two choices that you could have done. One choice you will take, and the other choice you decided not to take, and the difference of whatever revenue those two choices would be is the opportunity cost, the choice of not making one decision over another. So the difference between that is what your opportunity cost is. You're missing out on the opportunity of using the other option, and the difference between those two choices is what you consider opportunity cost. And then the ledger costs, those were utilities, material, rent, whatever will show up on an accounting ledger. So when you take both of those away, that's what you consider to be economic profit. So big difference there then is the opportunity cost. So you're taking out accounting costs and opportunity costs to get to your profit. So the next thing we're going to talk about is the different kinds of expenses or costs that crop up when as a business owner. First of which is fixed costs. Next is variable costs. So a fixed cost is one that remains, it continues to stay the same, regardless of how much product you make or how much quantity is produced. Your fixed costs stay the same. A good example of that would be rent, because the rent stays the same every single month, regardless of how many widgets you produce. Variable expenses, they are the ones that change based on what kind of quantity is produced. So, say you're making a cake, and you have the flour, the sugar, icing, and your materials, flour, sugar, icing, change based on how many cakes you're making. So, if you're making 100 cakes, you're looking at maybe 50 pounds of flour. If you decide to make 50 cakes, you might be looking more like 25 pounds of flour. And when you buy, the difference between 25 pounds of flour and 50 pounds of flour is quite a bit of money, and that's where the variable expense cost comes in. You probably are paying $25 for 25 pounds versus $50 for 50 pounds, and so that cost is changing you based on how much flour you bought. So it variates, it's variable based on how much you spent, which is the biggest difference between something that is fixed and doesn't change, and variable is one that does. So both of those kinds of costs help with analyzing both the law of diminishing returns and marginal analysis. Marginal analysis is when you decide to analyze something, the biggest difference between making two decisions, and what the biggest impact would be over one choice versus the other. So taking that marginal analysis and using it in the law of diminishing marginal returns is when you have analyzed it and have found that your productivity or your efficiency decreases as your quantity input increases. So the more product you create, so like let's just say you have making those cakes, and you have 2 machines making those cakes. Well, you decide that you did a marginal analysis and decided, what if I added a third machine to make even more cakes? So what the law of diminishing marginal return is, if you find that if you were to buy that third one, you would get the law of diminishing marginal return. That means that as your productivity, that means that having those 3 machines versus 2 machines making cakes decrease your productivity. And the only ways, there's lots of ways that could happen, but some of which are wherever there's a choke in the manufacturing process. Let's just say you can only make cake boxes so fast, and no matter how many cakes are made, if you can't make cake boxes as fast as you can make the cakes, then it doesn't matter how many machines you have making cakes if your boxing can't be as fast as that. So that would be a good example of when productivity decreases because you can't sell any more of them than you did before by adding a new machine. As your quantity output increase, so say you made 100 cakes, this allowed you to make 150 cakes. You can make a lot more cakes, but in the end you can't sell 150 of those 100 because you aren't able to box them just as fast as making them. So as your input increased, so you got 3 more machines, your input increased from 100 to 150, your productivity decreased because you're still not able to output as much as you're inputting. So that would be the law of diminishing marginal return. So product function is when you're comparing a quantity of inputs and a quantity of outputs. So that would be what happens if I decide to put sprinkles on the cake and icing of 5 different colors, and box it in certain kinds of different kinds of boxing, boxes so that they're more attractive to somebody, and how that changes your quantity of outputs. If you decide to decorate it extravagantly, how many less cakes are you able to output? So that's just talking about production function. So how much production are you getting out based on the functionality of what you're producing? So moving on to dead weight loss, that's when if your efficiency decreases by a certain amount, it will eventually lead to a loss in a profit. So at some point, you're going to see your profit decrease if your efficiency is decreasing, and any amount of decrease in your profit because your efficiency went down is called dead weight loss. So this is on to more of an economics point of view versus a business's point of view. More of a macroeconomics information here on the last couple of slides here. Got 4 more left. So what is known as the business cycle are when the economy expands and contracts, which what that means is that it does well and then it doesn't do as well. So on a graph that would look like something going up and down, which I have a visual here that might kind of give you a good idea of what I mean by that. On the left you see gross domestic product is what we're tracking, and on the left and on the bottom there on the x-axis is time. And what you'll see is a wave happening. There are peaks to that wave and there's troughs to that wave. The peak is at the top, and what you see is the economy, increasing, doing well over time, and peaking at some point, because at some point it won't do as well as it was doing. What happens is the GDP is going down, and it's considered to be a recession. And however drastic these peaks and troughs are just determine how fast this GDP in particular is going up or down. So at some point you get down to half as good as you were before, and going below that is twice as bad as it was before. So that's when it's considered a depression. Whatever is underneath this average line right here is the depression, in which it's considered the trough. And at some point it reaches it's low on the trough, because it goes back up into what's considered the recovery section, in which it is steadily increasing, breaking through that average and going back up to the peak for what's considered the expansion. So you have recession, and then you have recovery and expansion. So I wanted to give you guys a visual of what this business cycle meant, and you'll see that in the next couple of slides. What all, instead of GDP, what all else those things can be in a business cycle. So that's what an expansion and contraction is. Expansion would be as it peaks, that's expanding, and as it recedes, that would be it's contracting. Contracting always getting smaller, expanding is always getting bigger. So that's why they call it expansion and contraction. So the expansion is what's considered a business cycle's first phase. It always begins out as an expansion. So a business expansion, what that encompasses, when it's increasing, is when GDP increases, the number of jobs increase, there's a higher average income, there's a lot of new businesses, businesses are expanding, and there's creating more and more of them, more franchises, all those things are ways in which you can tell if the economy is expanding. Sorry, my cat is meowing like crazy. So keeping on with this business cycle, the peak of the business cycle is when all of those certain things reach a high. when the GDP reaches its peak, its highest, when the household income is at its highest, and when unemployment is at its lowest. Because you want unemployment to be as low as it can be. That means that as many people are employed as can be. And the trough of the business cycle, what that means is that there's a turning point in which the cycle reaches its very lowest, when it has ebbed as low as it can, in which an expansion is going to follow. So when you see those numbers turning back up to get to a peak, when GDP is going back up, household income is going back up, unemployment is going back down, is when you'll see the trough end and it try to reach to a peak again. So that climb is right here, where it's recovering from its low point, going back up to an expansion. So the business cycle calendar is what's considered the time between two peaks or two troughs. So on this picture, it would be the time between two peaks would be here and here would be the time frame, or two troughs, which aren't pictured. Oops, I made that too large.